In April 2025, the stock market felt something it hadn't felt in a long time: fear. Real, tangible, data-backed fear. Not because of inflation. Not because of war. But because of tariffs. Again. Just weeks after President Donald Trump announced a sweeping set of new trade measures, including a 10% baseline duty on most U.S. imports and an even higher, reciprocal tariff, plan, the financial markets responded sharply. Investors didn't just hesitate. They sold. Fast. The S&P 500, which had been climbing for most of the first quarter, fell more than 7% in highly volatile trading. And since its February peak, it has dropped by more than 14%. That's not just volatility. That's a red flag. In response, the biggest names on Wall Street did something rare: they backtracked. JPMorgan, Bank of America, Evercore ISI, Citigroup, and at least 6 other major institutions slashed their forecasts for the S&P 500 for the rest of 2025. Just months earlier, they had projected a continued bull market. Now, many of them are predicting barely 2% growth for the year, and some are warning of a potential full-blown recession. Citigroup's new base case target? 5,800, down from 6,500. JPMorgan? Down to 5,200. And BCA Research, which issued the most bearish view, expects the index to plunge to 4,450 by year-end. That's a 15% drop from current levels. What's going on? And more importantly, what does it mean for investors, institutions, and the global economy? Let's start with the trigger. On April 2, President Trump shocked the markets by reintroducing a series of tariffs, some of which mirrored his first-term trade war strategy, but others that went further. The plan included an immediate 10% baseline duty on nearly all imported goods, with reciprocal tariffs targeting countries with imbalanced trade relations with the U.S. initially. Markets hoped the rhetoric was political theater. But the actual announcements came fast and real. Electronics, cars, machinery, pharmaceuticals, everything was affected. Then came the confusion. Within days, the White House carved out exceptions for smartphones and some other electronics. Then it paused the reciprocal tariffs altogether. That sudden policy U-turn only increased investor uncertainty. Economists called it whiplash. Markets called it chaos. Scott Kronert, Citigroup's lead strategist, summed it up in one line: the Goldilocks sentiment in place entering this year has given way to abject uncertainty. He's not wrong. At the start of the year, Wall Street expected a strong performance for U.S. equities. A Republican administration with promises of deregulation and lower taxes had fueled optimism. But the new wave of tariffs flipped that narrative. Suddenly, everything looked different. Trade costs were rising. Supply chains were threatened. And most importantly, earnings projections for major U.S. companies began to fall. Citigroup cut its 2025 earnings per share estimate for the S&P 500 from $270 to $255, below the consensus average of $262. That may sound like a small adjustment, but it represents hundreds of billions in potential market value. Peter Berezin at BCA Research warned in mid-February that the economy was already vulnerable, and that these policies could trigger a recession within months. There's a lot of groupthink on Wall Street, he said. But this time, the downside risk is real. So how does artificial intelligence fit into this picture? AI-driven trading systems didn't just react to the tariffs. They anticipated the consequences before most human analysts could. Several high-frequency models picked up on shifting language in policy documents, unusual shipping data out of Asia, and subtle sentiment changes in political press conferences. Within minutes of the April 2 announcement, algorithmic trades surged. Major ETFs rebalanced. Commodity hedges spiked. I wasn't watching the news. It was decoding it. This explains the speed of the market's reaction. It wasn't panic. It was automation. And that raises a new concern. What happens when machine-driven markets respond to unpredictable human decisions? One bank strategist put it bluntly, this might be the first bear market triggered specifically by a US president's actions. Now, to be fair, markets have recovered from tariff shocks before. In 2018, during Trump's first trade war, equities dipped and then rebounded. But 2025 is different. First, the valuations are higher. After 2 straight years of 20% plus gains, the market was already priced for perfection. Second, interest rates are elevated. The Federal Reserve's recent moves to maintain restrictive monetary policy means that borrowing is expensive. That limits corporate flexibility and hurts growth. Third, global economic fragility. Europe is stagnating. China is still rebalancing. And now, the US is introducing friction into its own recovery. Put all that together, and Wall Street had no choice but to revise its outlook. But what does that mean for individual investors? Well, it depends on your timeline and tools. If you're using traditional models, price-to-earnings ratios, trailing indicators, historical correlations, you may be caught off guard by this market's behavior. But if you're leveraging AI, you might already be adapting. Tools like ChatGPT, AlphaSense, and Bloomberg's GPT-embedded analytics are helping professional and retail investors identify early signals. They're not just looking at earnings reports. They're scanning trade flows, legal filings, satellite data, and even diplomatic transcripts. And what they're showing right now is a market under pressure, but not necessarily doomed. Despite the lowered targets, most banks still expect the S&P 500 to recover in the coming months. The average year-end forecast now sits at 6,012, up about 14% from current levels. That's slow by past standards, but far from a crash. Still, investors need to be cautious. Watch for revisions to earnings. Look closely at sectors most exposed to tariffs, tech, manufacturing, and consumer goods. And most importantly, watch Washington. As JPMorgan wrote in its April 7 note, this Liberation Day shock came at a time when valuation was rich, positioning was crowded, and leadership was particularly narrow. That's Wall Street code for we were already vulnerable, and this policy just pushed us over the edge, so what happens next? If the tariffs stay paused, and negotiations improve, markets may stabilize. If Trump reintroduces reciprocal duties and targets European imports, the next leg down could be severe. If a recession takes hold, expect a rotation toward value, defensive stocks, and commodities. And through it all, expect AI systems to act first. Because in 2025, the market doesn't wait for headlines. It reacts to signals. And as this episode shows, even the perception of instability can send billions fleeing in milliseconds. That's not investor fear. That's algorithmic flight. So as we enter this new phase of uncertainty, ask yourself, are you prepared for a market shaped by tariffs, driven by AI, and reacting faster than humans can blink? Because whether you like Trump or not, agree with tariffs or not, one thing is clear, markets are watching closely. And they're no longer waiting for permission to move. If you found this breakdown valuable, don't forget to subscribe to AI Finance Mastermind. Here we bring you high-impact insights at the intersection of artificial intelligence, money, and power. This video is for informational and educational purposes only. It does not constitute financial, investment, or legal advice. Always do your own research and consult a licensed professional before making financial decisions.